Welcome to this week's episode of MacroNav, your market compass. In this series, we step back from the noise and explain how to read global markets from a true macro perspective, connecting policy, growth, inflation, sentiment, and geopolitics to what really drives asset prices. Today's episode is titled Global Markets Outlook: The Great Divergence and the Balancing Act. We'll unpack why markets appear stable on the surface, why that stability is increasingly misleading, and how to navigate a world where regional dispersion, not global averages, defines performance. Let me start with a simple observation. Global markets look stable, but that stability is increasingly an illusion. At first glance, headline indices held up well through late January 2026. But the reality underneath is far more fragile. The easy part of the rally is now behind us. We are no longer in a world driven by abundant liquidity and multiple expansion. We've entered a far tougher phase, one defined by earnings discipline, execution risk, and economic friction. This is no longer about a rising tide lifting all boats. It's about which ships can survive the collision between record equity highs and a deteriorating underlying reality, marked by weakening consumer confidence and stubborn producer inflation. The Federal Reserve's decision to pause rates at 3.50 to 3.75% perfectly captures this tension. On the surface, it offers relief. But beneath that relief lies a warning: inflation is proving sticky. And that raises the risk of being trapped in a prolonged high-rate environment. So when we look beyond the surface of global indices, the facade of stability begins to crack. This is the moment when optimism needs to give way to tactical discipline. One of the biggest strategic mistakes today is relying on global averages. We've entered an era of significant performance dispersion, where global growth, as a concept, has lost its usefulness. This week made that very clear. Europe surprised to the upside, while Japan stalled under political uncertainty and currency volatility. In the US, the S&P 500 eked out modest gains, but driven largely by defensive rotation into large-cap value. Europe's Stoxx 600 quietly outperformed, supported by better-than-feared earnings and a GDP surprise. Japan, on the other hand, fell sharply as the yen swung violently ahead of elections. China barely moved, reflecting not stimulus but deliberate cooling. The takeaway is simple: the rising tide has receded. Regional politics, currencies, and sector composition now determine outcomes. Global beta is no longer your friend. Nowhere was this more visible than in the US. The S&P 500 briefly broke above 7,000 intraday, only to reverse sharply. That move wasn't just technical noise. It was valuation gravity reasserting itself. This level marks the collision between optimism and reality, sustained high rates and stretched multiples. And the market response has been decisive. We are seeing a violent style rotation. Growth is out, value is back in. Large cap defensives are attracting capital, while small and mid caps are lagging badly. That underperformance is telling. It signals that investors don't trust the breadth of the economy. They are clustering around perceived safety. And when confidence narrows like this, it tells us something important. The floor is weakening, even as prices flirt with the ceiling. This brings us to one of the most dangerous disconnects in the US economy today. On paper, the labor market looks solid. Initial jobless claims are low. Continuing claims are at their best levels since late 2024. But confidence tells a very different story. The Conference Board's Consumer Confidence Index has collapsed to 84.5, a level we haven't seen since 2014. That gap matters, because confidence drives spending, and a consumer who feels poor, even if fully employed, eventually pulls back. This disconnect suggests consumers are anticipating something structural, something the hard data hasn't yet captured. And that makes sentiment, not employment, the key risk to domestic demand. At the same time, monetary policy is becoming noisier, not clearer. Jerome Powell continues to emphasize a cautious, data-dependent approach. But the nomination of Kevin Warsh as a potential successor has injected political uncertainty into the policy outlook. And all of this is happening as inflation shows signs of re-acceleration beneath the surface. Producer prices rose sharply in December, but more importantly, margins are widening. Wholesalers and retailers are passing costs through aggressively. That means inflation is no longer just a supply issue. It's becoming structural and margin-driven. The implication is clear. the easy phase of easing is over. Policy uncertainty is here to stay, and that uncertainty is now a defining feature of U.S. markets. Europe, meanwhile, is quietly defying expectations. Eurozone GDP grew 1.5% in 2025, with momentum picking up in the fourth quarter. France rebounded as fiscal tensions eased, and sentiment indicators are stabilizing. But let's not confuse resilience with escape velocity. Germany remains the bottleneck. Growth forecasts have been slashed due to delayed reforms. And in the UK, high borrowing costs are finally hitting home, mortgage approvals are at their weakest in 18 months. Europe is outperforming by default, but without structural reform, this recovery has a ceiling. In Asia, the picture is even more cautious. Japan is stuck in a holding pattern ahead of elections. Currency volatility and fears of unfunded tax cuts have frozen momentum. China, meanwhile, is executing a deliberate cooling strategy. Provincial growth targets have been lowered, stimulus remains restrained, and the message is unmistakable: growth at all costs is over. China is no longer the world's growth insurance policy, and that has long-term implications for global demand and commodities. Looking ahead, the coming week is critical. 5 risks stand out. First, U.S. labor data. Any sharp slowdown would shatter the soft landing narrative. Second, persistent producer inflation, which could eliminate hopes for rate cuts this year. Third, ECB communication. Hawkish missteps could choke Europe's fragile recovery. Fourth, Japanese FX intervention, which risks violent unwinds in global carry trades. And finally, China's PMI data, which may confirm a faster than expected slowdown in global demand. So where does that leave us? Markets are locked in a tug-of-war between superficial price strength and weakening fundamentals. The bull case rests on the Fed pause, European resilience, and selective earnings strength. The bear case rests on collapsing consumer confidence, sticky inflation, and rising political uncertainty. The reality is this: the safety net has been removed. The rally may still be alive, but it is no longer forgiving. Tactical caution is no longer optional. It is mandatory. The next quarter will be decided not by hope, but by execution, discipline, and the ability to navigate divergence in a world where stability is no longer guaranteed. If you found this macro framework useful, please share this episode, like it, and subscribe to the channel. That support helps sustain MacroNav and encourages the production of more in-depth professional market content like this. You can also claim the full presentation slides for free. The link is in the description. Until next week, stay disciplined, stay curious, and use macro as your compass.